All right, welcome everybody. This is You've Got Options for Income Navigator, and today is Wednesday, July 9th, 2025. Hope everybody's doing well. Today we're going to talk about iron condors. Before we get started, I'd like to remind everyone that whatever we're going to talk about today in this presentation, all content is for education and or your entertainment purposes only. We're not a broker dealer. We don't solicit any buy or sale of any securities, options, derivatives, whatever it is. Do speak to your financial planner, advisor before you consider doing any trades live. So we're going to talk about Iron Condor basics. For those of you that have been trading with me for quite some time, you know I am Igor. I am also a co-founder with Tom of IncomeNavigator.com. Today's agenda, we're going to talk about iron condors. We're going to discuss what an iron condor is and how it works. We're going to talk about when and why we want to use it. We would like to understand the potential profits, the risks. We're going to look at probabilities, and we're going to talk about how to manage a trade and how to make adjustments if adjustments needed. I know this is going to be hopefully clear as far as adjustments go, but we are not going to go and talk about some super advanced, super complicated adjustments. We're going to try to keep this very basic. If there is a need for more advanced training, we are going to create one for traders that are more advanced in our community. But for today's presentation, we're going to stay on the very basic level. If you have any questions, if something isn't clear, I encourage everybody to ask questions. There's a chat box here on Zoom, so don't shy away. We're going to get into questions very soon. I don't have a ton, so hopefully we won't be here for a long time. Hopefully we'll get this done in about, I don't know, half hour, maybe 40 minutes, and then we'll do a Q&A at the end. Hopefully I will be able to answer all of your questions and make things clear. So we're going to get started with what is an iron condor. For those that are not familiar, it is a neutral options strategy designed to profit from a limited price movement. To build an iron condor, we would use 4 option contracts. In other words, an iron condor is made up of 2 credit spreads, a bear call spread, where we sell an out of the money call and we buy a further out of the money call, right? That creates a call credit spread. And on the other end, we are selling a put credit spread. We sell an out of the money put, we go further out of the money, buy a farther out of the money put. That creates a bull put spread. Putting a bull put spread and a bear call spread together makes it an iron condor. You collect the credit up front and you hope, I don't know if hope is the right term here, but we hope for the price to stay between the short strikes, right? If we're going to look for the price to stay between the short strikes, right, this goes to speak about profit from a limited price movement, right? The underlying can go up a little, it can go down a little, it can go nowhere, and we should be able to make a profit with an iron condor. The only one time where iron condor is not going to be profitable is if we see a very large move either up or down, and depending on how you go about managing and executing your trade, sometimes you can lose on both sides. It's very unlikely, right? If you exit out of a trade, if you cut the trade due to a stop loss and you take off both a bear call spread and a bull put spread, then you can only lose on one side. I will talk about an instance where I thought I could outsmart the market and decided to take one side, leave the other, and I got spanked on both ends. Let's move on. So why do we want to trade iron condors? Technically, iron condors are a very high probability trade. Price only needs to stay within a range, right? So if we set up a trade in a way where our short options are very far out of the money. The further out of the money we place our short strikes, the higher probability the trade setup is. Also, iron condors are great for those that don't want to trade undefined risk or sell options naked. This is a defined risk trade, and you know exactly how much you're going to lose before you take the trade, right? So you can use that information to potentially size your trades and therefore control your risk. This is also a defined reward trade. Your max profit is the credit that you're going to receive up front. That means that no matter how fast, how slow, how far the underlying is going to move, if the trade is going to work out, the most you can possibly make with an iron condor is the upfront credit that you're going to receive. Unless you make adjustments to bringing additional credit, um, your max potential profit is limited to the amount of credit you're collecting up front. Another benefit to iron condors is the time decay, also known as theta. Time decay works in your favor as each day passes by. All options are going to lose value. As we know, options are a wasting asset, right? They decay over time. They also decay over price, and they will also lose value as volatility will fall. But time decay, the theta component, is one of the biggest benefits for iron condors. And we get a lot of time decay with iron condors. It is ideal for sideways or low volatility market conditions. When we say low volatility, we're talking about low realized or historical volatility, right? When volatility is very low, for example, we're in the summertime right now where technically volatility is fairly low, right? There's not a whole lot of activity typically. Lots of big hedge fund managers, they want to pack their bags and run to the Hamptons on a Wednesday, maybe early Thursday, and Friday's kind of quiet. So yeah, when the market is the, the realized volatility is fairly low in the marketplace, it is ideal time to trade iron condors. That's not to say that we want to sit around all year, wait for the summertime when we anticipate realized volatility to be low to start trading iron condors. I think iron condors can be traded in all sorts of different markets. It's all about how you're going to set your trade up. If you are going to use some kind of a signal to enter or manage your trades, the better the signal, the better the trade. Let's look at a example setup. Let's just say, and this is based on current prices or something close to it. I like to use SPX. It's a large contract used by professional traders. It's fairly liquid. And this is a benchmark that I use. You can use whatever underlying you can use in place of SPX. You can look at SPY. You can look at ES if you want to trade options and futures. You can trade MES if you want to trade a smaller futures options contract. But I like to use SPX, so we're going to use SPX for our purposes today. So on the call side, right, assuming SPX is trading somewhere around 62.50, on the call side, we're going to sell 64.50, which is about 200 points out of the money, right? We sell a 64.50 call, and then we buy a 6,500 call, which is 50 points farther out of the money from our short strike. This would make it a 50-point wide call credit spread. And on the put side, we would sell a 60.50 put, which is about 200 points out of the money from where SPX is currently trading. And then to define our risk on the downside, we would buy a 6,000 put, which is 50 points below the short put, which also make this a 50-point wide put credit spread. So we're selling a call credit spread and a put credit spread, combining the two. That makes it an iron condor. We get to collect a total premium of about $22, right? So we have a 50 wide iron condor. We collect $22 up front. Our max profit is 22 points, right? It's 22 per share. We know that SPX has a multiplier of 100. So we take 22 times 100. This is equivalent to a max profit of $2,200 per one contract. Our max loss is the spread width or width of the spread. We know we have a 50-point wide spread on both ends, right? So that's 50 points minus the credit that we're collecting, which is 22 points. 50 minus 22 is 28. 28 times 100, that's a max potential loss of $2,800. And that is also what is required by your broker to put the trade on, right? So you put the trade on, you collect 22 points or $2,200 up front. Your broker will ask for $2,800 to secure this trade, which means that if the underlying moves up or down and goes through your short and your long strike on either side, at expiration, you cannot lose more than $2,800, right? Because a 50-point wide spread, whether it's a call spread or a put spread, a 50 wide spread cannot be worth more than 50 points or $5,000, right? So your max loss is $5,000, but that $5,000 gets offset by the credit that you're collecting, right? You can't lose money that isn't yours. When you take in that $2,200 up front, well, you can't lose that because it's not your money. You could make it and make it your money. But if you're collecting $2,200 with a 50-point wide credit spread, you have to put up $2,800 because the most you can possibly lose is $2,800, right? So in this situation, you know your max potential profit and you know your max potential loss. With that information, you can potentially size your trade. This is what a risk graph of this trade that I mentioned above. This is what the risk graph looks like. As we can see, we have a 200 points out of the money. So the distance between spot price, right? SPX is at 62.42, so we can round this off to about 62.50. We go 200 points out of the money. That's where our short call is. And then we buy a further out of the money long call to make this a call credit spread. And then the same thing on the downside. We are going 200 points out of the money to find our short put. And then we go 50 points further out of the money to find our long put. That will make it a defined risk trade, right? We sell two credit spreads. That makes it an iron condor. We collect $2,200. That is the most we can possibly make inside of our break evens. Max profit occurs between the short strikes, which is on the downside, that's 60.50. On the upside, it's 64.50. Losses will happen if the price breaks below the longs, either put or above a long call, right? So the wings of these two spreads, right? We have a wing on the upside at 6,500, and on the downside, right, our long is at 6,000. So what happens is at expiration, if the price or if SPX at expiration is above 6,500 or below 6,000, that's where max loss or that $2,800 that we figured out is our max loss is. That's where that loss will occur. Now, our break evens in an iron condor, we just take our short strikes and then we either add or subtract the credit. Because as you can see, my short strikes, right, these lines here, that's my break even. And you can see that my break even is slightly farther out of the money than where my short strikes are because what moves our break even farther out of the money is the initial credit that we're collecting. So to figure out our break evens, on the downside, we'll take our short strike and minus credit. On the flip, on the upside, we'll take short strike plus the credit. So that will give you your upside and your downside break even. So how do we set up the trade? We choose liquid underlyings, and this is one of the most important parts when it comes to risk management. We want to find very liquid underlyings. We don't want to put ourselves in a position where we, choose some high flying, um, high beta name that is maybe super hot right now because there were some headlines in the last couple of days. So we thought that, oh, it's going to cool off and it's going to maybe knock out some sort of a range, right? We get into the trade, and then 2 weeks later, no one cares and no one talks about this company anymore. There's zero liquidity. Bid ask spreads are stupid wide. And we want to get out if we're hitting our profit target, or worse, if we need to close out a trade because it's moving against us. But the market makers will hold you hostage, right? Because there's very little liquidity. You can find yourself in a whole lot of trouble and potentially take a much bigger loss than you initially planned for. Liquidity is very, very important. You want to talk about liquidity, you want to look at, you know, highly traded or most traded underlying such as SPY, QQQ, IWM. You can also look at, the Apples, the Teslas, the Amazon, the largest market cap companies. Um, and, I talked about this before. When I look at, or if I scan for what underlyings am I going to trade options with, right? I want to find the most liquid names. I will start with um, a company that is in the S&P 500 index, right? So that technically should give me 503 names. And then from there, I will go and I will only look at, right? I'll set my filter to give me only names that have weekly options available. It's not going to cut it down to just 10 underlyings. It's still going to give you a large number of companies, but it'll filter out those that don't have weekly options. Right nowadays, with SPX having daily expirations, there are a large number of companies that have options that expire every week, which means there's demand for weekly options, and odds are there's enough demand in every expiration cycle to give you enough liquidity. We can talk about looking at open interest of at least 10,000 contracts, because so you can set your filter even further to um, filter out those that don't have a combined open interest of at least 10,000 contracts. So you could boil it down to just, you know, 10, 20, maybe 30 names out of 500. And those are going to be the most liquid names, which means you are getting in easier, maybe with less slippage. And more importantly, it's about getting out, right? Getting out is the most important, because anybody could get into a trade, but when you need to get out, liquidity is key, right? And you also want to look at bid ask spreads. They need to be fairly tight. You go out 45 to 60 days until expiration. Now, this 45 or 60 days is not, the only thing that works and everything else doesn't, right? This is just a guideline that I use. If you want to, not be glued to your screens, you go with 45 to 60 days. I think that going, maybe all the way to 90 days is still acceptable. Anything beyond that, yes, you can go with leaps if you want, but you'll wait forever for that decay, and you just expose yourself for a lot longer, which means that holding for longer exposes you to the risks of something terrible happening, not in the next 2 weeks, not in the next 2 months, but maybe in the next 9 months, right? So you get the benefit, you get to go way farther out of the money on your short strikes, which technically gives you a higher probability setup, right? Makes your trade much safer, but you're going to commit to that trade for a lot longer. And therefore, you are increasing chances of being in the trade if, and I want to highlight, if something terrible happens down the road. If you want to kind of find a balance between, decent premium and decent rate of decay, I think 45 to 60 days is kind of a great time frame to look at when you're trading iron condors. You can also use zero DT options to trade iron condors, which have become very popular in recent years. But for me, 45 to 60 days is kind of a benchmark. You want to sell options around 15 to 30 delta for a good balance of premiums and probability. We talked about delta before. Delta gives us, an estimate of an implied probability of profit, right? A 15 delta option tells us that there's only about a 15% chance that this option is going to be in the money at expiration, right? So the lower the delta, the higher your probability is. Selling deltas somewhere around 15 will give you a short option around a one standard deviation, right? So you would expect the price of the underlying to remain between or inside of that short strike about 70% of the time, right? So you can go narrower, meaning you can go higher delta, right? And we'll talk about the risks of that, or you can go farther out, right, to lower deltas and give yourself a higher probability. The trade-off is, right, you're trading off higher probability for smaller premiums. So you can be safer, but you'll make less and you'll risk a little bit more. So there's always going to be this balance between risk reward and odds, right? The better the risk reward, the worse the odds. The higher the odds, the more terrible risk reward is going to be. And that's never going to change. You want to use equal distance for your spreads, equidistant spreads, equal width spreads, right? If you're going to use 10-point wings, it needs to be equal on both sides, meaning your put credit spread is 10 points wide. Your call credit spread should be 10 points wide, right? That makes it a balanced iron condor. Now, I'm not making the case that, you can't trade unbalanced iron condors, right? There's a place and time for all sorts of different variations of iron condors. But in general, a standard iron condor has to be balanced, which means that if you have a 10-point wing on the put spread, it should be a 10-point wing on the call spread. If it's going to be a 50-point wing on your put spread, like I'm using in this example today, your call spread should also be 50 points wide. Unless you want to tilt the trade in any direction based on your technical analysis, maybe your bias is to either upside or to the downside, then you can look to unbalance by maybe making one side wider than the other. And you know there's definitely a place and time to do that too. You want to make sure you're collecting enough credit to justify the risk. Um, I think this is more um, proprietary. I guess you want to understand the risk of underlying staying within a certain range, and you want to align that against the risk reward proposition of your trade, right? So if let's say if you think the odds of the underlying moving out of predefined range is greater than 50%, then doing a iron condor where you're collecting $5 for a 10-point wide iron condor doesn't make sense, right? You may want to go a little bit wider, right? And if you're reducing your credit that you're collecting up front, you're obviously going to be exposed to a little bit more risk, but you're also going to have a much wider range of the price to move around and for you to potentially still make money. Let's move on and talk about understanding the numbers. So we kind of already covered this, but let's just refresh. Max profit in an iron condor is a net premium collected when you open the trade, and that does not change unless you're going to start to make adjustments, rolling your spreads in or out, right? If you collect additional credit, you will increase your max profit, but you're also going to decrease your probability of profit zone a little bit, right? There's always going to be that trade-off. You improve your risk reward, you're going to make your probability of profit a little bit worse. Our max loss or margin requirement for an iron condor is the distance between the strikes, right? This is the width of the spread minus credit received. So in this example, right, how do we calculate our break evens? We take our upper on the upside, we take our upper short call strike and we add credit to it. And on the downside, we take our lower short put strike and we take out the credit. In Here's an example, right? Let's assume, to make things a little bit simpler, instead of doing a $22 credit, which is what this 50-point wide iron condor was going for, let's assume we're collecting a $20 credit for a 50-point wide iron condor. So we know we have a $20 credit, or $2,000 is our max potential profit. To figure out our break evens, right? We take a $20 credit on 60/50, 6,000 put spread, and 64/50, 6,500 call spread. Our break evens are 60/30 on the put side, right? Because we took our short strike at 60/50 and we took out the $20 credit, right? So the $20 credit pushed our break even from 60/50 down to 60/30, right? It improved our downside break even by the amount of credit that we're collecting up front. And on the call side, if we're selling a 64/50 call, right, that's not our break even because we're also taking in a $20 credit. So we add $20 credit to 64/50, and that gets us to 64/70. So, and if we took in a $20 credit, given these strikes, our downside break even is 60/30, and our upside break even is 64/70, and that is at expiration. Right, and we could see that these numbers are going to be very close to it. Hopefully, you can see this um, on the software that I'm using. So those are our numbers. Let's talk about when we want to trade iron condors. The best iron condor is set up when you expect the stock to stay within a range. Now, there is no one tool that will tell you exactly when or why any underlying is going to do anything. Because if there was such tool, right, anyone using this tool would be the richest person in the world. However, we can use some indicators, we can use some oscillators, we can use some tools that are available to us, right, to kind of give us some clues or hints when we should expect some kind of range bound price action. We know that, the market trends maybe 75, 80% of the time. Sorry, market consolidates 70% of the time, and then it only trends about, 25 to 30% of the time. So a lot of time the market is just going to go sideways, or, it's just going to consolidate. So identifying those times is really what makes the difference between, setting up an iron condor campaign style. You can pick your spots and, therefore increase your potential probability of a profitable outcome. But you have to be good at, timing the market, finding those times. A lot of times we see market, or whatever the underlying is, right? I keep saying market because I refer to SPX or S&P 500. We would make a move to the upside. Maybe we squeeze a bunch of shorts out, and then the market will consolidate to punish those that are chasing, or that are late to the game, right? So the market's trying to kill everybody on both ends. Those that missed out on the move, and then those that are chasing late, right? They're buying a bunch of overpriced options, thinking that the move is going to continue. The market stops. We go back and forth. Maybe we wait for moving averages to catch up. Maybe we're waiting for Bollinger Bands to start to pinch in a little bit, right? And therefore, if you could identify when the market is due for some kind of a range-bound corrective price action, that is the best time to enter an iron condor. You want to look for high probability, high implied volatility rank, right, to set up your high probability trades. I'm going to say that if you're going to sit around and wait for high implied volatility rank, right? You may only take two trades a year. It depends, right? There were times where, IV rank didn't go above 60 all year long. And if you only set, yourself up for, I'm only going to take trades when, IV rank is at 75 or higher, or 80 or 90, right? Those are super high IV rank numbers. Maybe you'll never get there in the year. So the idea is you want to sell iron condors, right? Because we're net option premium collectors there. We want to set up our iron condors when implied volatility is relatively high relative to itself, where it has been over the past, 250 days. But more important than anything else is that we have to anticipate the volatility to mean revert, right? Because let's use this as an example. If we have the VIX at 18, right, and the VIX goes from 18 to 23, right? 23 is quote unquote high, because if VIX was at 16, then it went to 17, then it went to 15, then it went to 18, and now it's at 23, right? 23 VIX is high, relatively speaking. But if volatility then goes from 23 to 40, right? 23 is really not that high, right? So we kind of want to wait for some sort of signal where volatility is peaking out, and maybe there's going to be mean reversion and implied volatility, and that is the quote unquote high volatility rank, right? We want to sell implied high implied volatility, anticipating volatility returning back to the mean, right? But there's also ways to kind of avoid a lot of that noise, right? Who's to say that trading iron condors when VIX is at 18, which could be relatively low, but historically implied volatility, or VIX on S&P 500 at 18 is the norm, right? So maybe VIX at 15 is the low end of the range for the VIX. And you could make the case that, hey, why would I sell an iron condor and SPX with VIX at 15, right? Because it's at the low end of the range, and it's, historically very, very low, which means the premium are not as rich, right? Why would I want to trade iron condors? And then I could make the case, well, if it's because the market is really not anticipating anything terrible happening. Now you have to look at, some potential upcoming events that may move the markets. But if we're, in a very normal market, we're grinding higher, maybe we're consolidating, right? There's nothing crazy going on around the world. VIX at 15, VIX at 16, or even at 18 isn't implying something terrible happening over the next 30 days, right? Because VIX is a forward looking, it's implied volatility for the next 30 days in the S&P 500. So you can make the case that, look, I'll take, iron condor trades when market is calm and not anticipating anything happening in the near future. So if you're trading iron condors with 30 to 45 DTE, right? And especially if you're not going to hold until expiration, look, VIX at 15, at 16, at 17 isn't implying a whole lot of movement over the next 30 days. And if nothing crazy happens in the next 3 weeks, even though the premiums aren't as rich as we would like it to be, your iron condor could still be a very profitable trade. Now you can say, look, I'm going to wait until the VIX is at 29 before I do anything, and that's fine. You will set up a trade that's going to have short strikes a lot farther out of the money, whether compared to if you were to take the trade with VIX at 16. So yes, VIX at 29 will give you a much farther out of the money short strikes, which will give you a much wider range where you could potentially make money. But VIX at 29, if we use a simple rule of 16 that will tell us what is the expected move for one day with the VIX at 29, we'll go 29 divided by 16. The market is implying about a 1.8% move on any given day, up or down, right? So do you want to set up trades when the market is implying that, hey, tomorrow we're going to be up or down 1.8%, right? This is not an easy market. Think to yourself, we've seen the markets when the market moves, you know, over 1%, right? And here you'll have the market that's implying a 1.8% move up or down the following day. Do you want to trade a strategy that benefits from range bound market price action, right? Because a lot of times when the market is implying a 1.8% move and volatility or the VIX is at 29, very often we move a lot more than what the market is implying because the market makers can't really price the options correctly, right? Or uh, because when volatility really picks up, right, everybody's kind of on one side of the trade. Either too many people are getting short and then the market goes the other way. And when it goes, it forces the shorts to cover and we go way more than what the market was pricing in. And the same thing on the downside. When the market starts to go down and everybody's scared, they go out, start buying a bunch of out of the money puts, and the market makers have to short more, ES or whatever they're going to do to offset their risk. And the market moves way more than what was being priced in. So, I can't say that, only trading when volatility is high is the right time or only trading when volatility is low is the right time. You kind of want to understand where you make most money, and that is the perfect market condition for you to trade. Like if you trade iron condors for a year straight, and maybe you go through times where volatility is elevated and sometimes volatility is kind of suppressed, you look back a year and you say, all right, let me go back, look at the chart, let me identify where the VIX was, what was the highest reading on the VIX, what was the lowest, and let me look at my results of my iron condor trades. And then you will notice that, hey, maybe you make the most money when the volatility is relatively low. Or maybe you make the most money when volatility is high and the trades that were put on during lower volatility environments just didn't really amount to enough, right? So you kind of have to use your own results to determine, where you want to trade or when you want to trade iron condors. As I mentioned already, you want to avoid big events such as earnings if you're going to trade individual stocks, right? You don't want to put on an iron condor on Apple going into earnings in the next couple of weeks because why? Well, implied volatility is going to rise, right? Decay is going to be non-existent because yes, the time is not going to stop. So you're going to get some theta decay, right? Which should technically give you the profits. But whatever you're making due to theta will be replaced with increase in vega, right? Because as the earnings is starting to approach, the perceived risk is going to increase. The market's going to, reach for those options to protect their positions, whether it's up or down or both, right? So implied volatility is going to rise, and an increase in implied volatility is going to offset any of the gains that you may see from the time passage or theta decay. You also want to avoid, the Fed meetings. We've seen this a lot in all sorts of different Facebook groups where people go there scratching their heads. Hey, it's Wednesday. I know the Fed's going to meet at 2. I sold something at the open. It's 1:30, but my options haven't lost anything. Why? Well, the Fed meetings, right? Until the Fed meeting, until 2 or 2:30 or sometimes even 3 o'clock after we get the decision, if there's a press conference, until all of that volatility will release and collapse, you're not going to get any premium decay. So Fed meetings, trading, 0 DT on Fed days, you're taking the risk at 9:30 in the morning. You will not get the result, whether it's profitable or not, until after the Fed meeting. And that kind of becomes a binary, almost like event, kind of like the earnings, right? You have all this premium built into the price of the options, and that premium isn't going to come out until we know the outcome of the earnings report, or at least we see the reaction to the earnings report. Very similar to the Fed meetings. CPI reports, they usually happen, before market opens. So if you do something, on the Wednesday and the CPI is coming out on the Thursday or on the Friday, whatever the case may be, you're not going to get the benefit. You're not going to get the reward for the risk you're taking until these events are out of the way. Now, some of them are less important than others because if you say, well, I'm only going to trade iron condors where there's no events going on, there's always something going on, right? So if you're just waiting for that perfect time, the only time nothing's going on is on Saturday and Sunday. And that's not always, right? So there's always something going on. You just kind of want to identify those that may potentially move the underlying the most and try to avoid that. FDA announcements, earnings, Fed meetings. I think those are some of the most important ones. Use technical analysis to find levels to help you choose your short strikes. If you identify some sort of very strong level of support or resistance, you don't have to put on an iron condor all in one trade, meaning all four legs all at once. You can say, you know what, I'm going to do 75 DTE iron condor in, whatever the underlying is. If we get to level A, which is very strong support level, I'm going to initiate a put credit spread. And then if I'm right, support is there, the underlying held goes the other way and it runs halfway towards the resistance, or if it reaches the resistance, whatever that level you identify on your chart, I'm going to add a bear call spread to make it an iron condor. Yes, you can do that too. There are ways to do it. You just want to make sure you don't run out of time waiting for the other side to come into play. Otherwise, you're just going to be trading one side of an iron condor or a credit spread as we know them. Let's talk about managing trades. There is a rule of, I don't know who came up with this, but 50% of max profit. Maybe guys at Tasty, they do, thorough research and, they come up with removing trades at 50% is the most efficient use of your capital. Okay, that's fine. I do agree that if we sold an iron condor, let's just say we sold a 10 wide for $5, right? So it's kind of it's almost like an iron butterfly maybe. Or maybe if we sold a 10 wide for $3, right? So that's kind of like selling credit spreads around the one standard deviation. So we collect the $3 up front. Our risk is $7, right? We have a probability of profit of around 70%. And now, once we get the first 50% from that $3 credit that we collect up front, right? If I get to 150, that may come out in the first, if we started the trade at 60 days, maybe we'll get there in the first 20 days, right? In the first 20 days, if I capture 50% of max profit, I have to ask myself, do I want to spend the other 40 days to capture the other 50%? Right? I think it makes sense to remove your trade or take profit at 50% if you get there much faster than halfway until expiration. So if you initiate a trade at 60 DTE, if you get 50% before the first 30 days, I think that's a great time to take the trade off and reposition. You can say, you know what, I already waited, first 30 days. I'm at, slightly more than 50% of profit. I think the risk of underlying moving outside of my break evens is now even less than it was when I first took the trade, which would make sense, right? The more time passes, the more certainty there is in the marketplace. And you can see that the break evens are now a lot safer than they were when you first initiated the trade. So maybe you want to wait for that 75% of max profit number. You probably don't want to wait until expiration and squeeze every last nickel of the trade because, hey, black swans always, around the corner, and you really never know when something terrible could happen. In the last 2 days, when it felt like your strikes or your break evens were so far out of the money, but something terrible happens in the last two trades of in the last 2 days of the trade, and then you watch a really really nice profitable trade turn into a nasty loser. So I think that you know close your trade for a small fraction of what you collected. Let somebody else deal with that headache, and move on to the next trade. I think that is the best way to go about it. You definitely want to have a plan for a loss limits, whether it's 1.5x credit or when you breach either side of the iron condor. These numbers here is not what the rule or what part of any plan, or these are just example or just guidelines. If it's 1.5x, you want to figure out what did I collect, on a 10 wide. If I collected $3 credit, if the trade is down 1.5 times my credit, right, which is 450, if my P&L is negative 450 at any given time, that's my exit, non-negotiable. Then that's your rule, and that's what you have to follow. And you know, if you want to give it a little bit more room, and you say, you know what, if I'm down 2x credit, which means, if I lost $600 on a $300 credit up front, that's my exit, then that's your exit, and that's the rule you have to follow. You may want to, put in something like a breach of a short strike. And I know that, our friends at Tasty, they, have part of their management protocol roll untested side when one gets tested. I don't like it. I'm not saying they're wrong or they're steering anyone in the wrong direction. I personally don't like it because if you have one side being tested and now you're rolling the untested side closer to at the money, there's a very high chance that the price is going to revert, right? Revert back to the mean or go the other way, or for whatever the case is. So now you have one side that's in trouble. You just moved the untested side way closer to at the money. The price will then go the other way, and now you have two sides that are in trouble because the first one still hasn't fully recovered. Now you have the new spread that you initiated by rolling the untested. Now that gets into trouble. Before you know it, you kind of dig yourself deep into a loss. I think that waiting for either side to be breached is maybe not the best. Identify how much are you willing to risk, right? You know your max risk, you know your max reward, you know your implied probability in the trade. Identify how many dollars are you willing to risk for an iron condor. If that gets hit, get out. Take notes, keep track of your trades. If you see that you get stepped out, on 4 out of 6 trades, you're probably trading in the wrong environment, or maybe you're setting up your spreads way too close to at the money, right? Or maybe your 1.5x credit is just too tight. So you could just do a little bit of tweaking and fix that problem. But it's not the problem with an iron condor. It's the problem of maybe timing your trade or maybe your trade setup. Will definitely help you out. Try to find the balance where, you have a high probability trade setup. You have a high enough win rate where your winners more than cover your losers, leaving you with a net positive outcome. Adjustments. I'm not a big fan of making adjustments on these kind of defined risk trades because, again, we already know what is our max risk. We know what's our max reward. We know what our implied probabilities are. We already know how much we're willing to lose before we have to pull the plug. If we start to make adjustments, a lot of times, right, making adjustments is just closing a bad trade and opening a new trade, right? If this adjustment isn't improving your position, you're just kind of defending your own ego. You're now setting this false sense of security that, oh, I'm going to make adjustments, I'm going to be all right, without realizing that you're just digging yourself deeper and deeper into a problem that could potentially result in a much bigger loss and, shake you up, not just financially, but also psychologically. Not a big fan of adjustments, but let's talk about them anyways. Rolling the untested side. I don't like it. You collect more credit, but you really cut your probability of profit zone by so much that if you get a move in the opposite direction, what are you going to do? You're going to move the other untested that was just recently tested. Now you're going inverted. Is it a way to do it? There is a way. It's not my favorite. You do what's best for you. Closing the tested side to limit your risk. That's what I wanted to talk to you guys about real quick. This has been a while since then, but a while back, I was trading iron condors. And these are very nice, high probability. They're very high win rate trades. And, I felt great. And, the market started to move outside of what it has been doing for, I don't know, like maybe 9 months or something like that. So I got to a point, I had a trade where I needed to close it because it's not that it tested one of the sides. I reached my stop loss, right? So for example, if I had a $3 credit, right, and my stop loss was, 1.5 times my initial credit. So if I'm down 450, I'm out. I reached the 450 loss. I said, okay, you know what? I'm just going to close the side that's in trouble, right? Because you cannot be in trouble on both sides at once, right? So let's say the market's pulling back, my iron condor is showing a $450 loss. It's mostly due because my put credit spread is in trouble. I close out a put credit spread thinking, all right, I close it out, whatever premium is left in the call credit spread, at least that's going to help me offset that $450 loss. And guess what? The market gods looked down on me and said, hold my beer, I'm going to show you, right? They run the market the other way. And now I'm taking another $400 loss on the other side. So instead of taking a $450 loss and walking away, I ended up taking like an $850 loss, which is, 2x, way more than what I planned for. And it wasn't because iron condor is a bad trade. It's not because market makers are evil or they know or care about who I am. It's because I decided to outsmart the market and I decided to close one side, leave the other one on. So I don't like the idea of closing the tested side to limit the risk. I think that's not a good idea also. But is there a way to do it? Sure, you can apply some sort of layers of filters to identify some price levels in the chart that if you remove one side and if the market breaches some price level on the chart, you're going to remove the other side to avoid putting yourself in the position that I did in that time. Converting to an unbalanced condor if price is trending. I used to trade these as well. I think they work fine. You just have to rely a little bit more on your price or chart reading skills. For example, you initiate an iron condor and let's say the price starts to trend higher, right? Instead of trying to figure out how to cut your losses on the upside, you start to sell maybe more put credit spreads to unbalance, right? So now if let's say you have 3 put credit spreads and only 1 call credit spread, your iron condor is unbalanced to the upside. So therefore you will smooth out the T+0 and you kind of will mitigate some of the losses from the call spread because you only have 1 call spread that's causing the losses, but you have 3 put credit spreads that are more than making up for it, right? So I'm okay with it, but it's also very discretionary and you have to understand and know what you're doing. Common mistakes: placing short strikes too close to current price, right? You think, hey, I'm going to really grab this market by the what and sell strikes way too close. Well, the market may have been just consolidating sideways and then you went in too close to at the money, almost kind of like a something that resembles more of an iron butterfly than an iron condor, and then the price will release and start to trend on either side. You get punished. And if that happens a lot, that's because, instead of identifying times where you anticipate some sort of market sideways or market consolidation, you put on an iron condor very close to, at the money, right before the implied volatility is about to start to expand and the price is going to start to trend, right? So placing strikes too close at the wrong time is a big mistake, in my opinion. Ignoring volatility, right? Again, this is not a black and white, but if you see volatility is going from 16 to 18, now it's at 20, and you said, there it is. This is what they're talking about. Sell high implied volatility. Well, we don't know if we're going to stop at 20. We can go from 20 to 25 to 40 to 60, right? So 20 is all of a sudden not so high anymore. So you kind of want to pay attention when volatility is starting to rise. You want to find the tipping point, right? When volatility looks like it's speaking out and it's going to start to revert. Just because it goes from 18 to 20 doesn't mean that volatility is high. Holding through binary events such as earnings, Fed announcements, FDA announcements can make the underlying move fast, right? And fast movements or large movements in the underlying is not good for iron condors because, where we started, iron condor benefits from sideways range bound markets or price action. Not respecting your max loss or adjusting too late. Again, I don't really like adjusting too much, but respecting your max loss, this is more of what I was referring to when I reached my max loss. Instead of taking the trade off, I decided, or I thought that I can outsmart the market. I completely didn't respect my max loss rules, and I was punished for it. Never did I do that again since. So that was a lesson. Allocating too much of your capital to any one position, it all depends on how you want to size your trade. For me, and this is for me only, right? Personally, I don't think that any one iron condor, right? You know what your max risk, you know what your margin requirements are. It should not be more than maybe 5%. And again, 5% is a very discretionary number. What is it? 5% of what? If you have a $50 million account, are you going to risk 5% on any one iron condor? Probably not, because if you convert that 5% into dollars, and is that too much for you? Maybe, right? You kind of need to ask yourself, are you comfortable putting that much money into one trade? If you have a $100,000 account and you say, you know what, 5% in any given iron condor, okay, that's more or less, something that I can stomach, because if something terrible happens where, the underlying goes outside of the break evens and you aren't able, or you're not around to close this position for whatever reason, and even though the chances of that happening are not really that great, but if you were to take a max loss, we don't plan on taking a max loss, right? Because we use like some sort of a multiple of initial credit to define our stop out level. But if you were, for some very weird and terrible reason, if you were to take a max loss on an iron condor, this cannot be like 50% of your account, because, recovering from that loss, now you have to double your account. So if you're going to continue to trade iron condors, it'll take you some time to double your account. So therefore, you need to define and you need to understand how much are you willing to put in any one iron condor, right? So you have to know your position sizing. And we can talk about position sizing. Again, I don't want to get too advanced, too deep into, we can talk about iron condors for 20 hours, right? And maybe we'll do a class or a course on iron condors, and we'll get into the Greeks and all, the different expirations, and comparing different expirations, comparing different credit spreads, the risks and rewards, and the probabilities in different market environments. But for today's purposes, understand what's at risk, how much buying power it takes up, and don't size your trades based on how much money you're going to make. If in this example that we identified, right, if the most we can possibly make is, 2,000 or $2,200, and maybe we're going to close this trade at a 50% of max profit, which means we're going to probably make somewhere around $1,000, right? And you say to yourself, well, I don't want to make $1,000. I need to make 10 grand. That would be nice, right? But you only have $100,000 account. Well, guess what? You're sizing this trade, right? You're going to take a 10x this trade, right? Which means your margin is not $2,800, it's $28,000, which means you have a third of your account in this one position. Also, what this means that if you were to use some multiple as your potential stop loss, right? Maybe it's 1.5x your credit. You have to multiply the credit by your, whatever 1.5 multiple. How many dollars is that per one contract? Now multiply that by 10, right? If you tried to make $10,000 here, but your loss, let's say it's 1.5 times credit, that's $3,000, right? $3,000 per one contract. You decided to 10x this trade because you didn't want to make 1,000, you wanted to make 10,000. But your loss is now not 3,000, but 30,000 in the $100,000 account. You just lost a third of your account with one trade. How much do you need to make just to get to break even? Right? It's not because the trade is bad. It's not because the market makers are terrible. It's because you sized the trade not based on how much you can lose. You sized the trade based on how much you wanted to make, and that's wrong, right? So sizing trades is very important, and yeah, you have to understand how much you're willing to risk, and size your trades based on that. All right, so we got to the end of what I had to say. Hopefully, you guys are still awake. If you have any questions, let's take 5 minutes, right? If you have any questions, this is the time to do it. I'll try to answer your questions. I think also it would be great if you have questions after today's presentation. You go on Discord, you can create topics, right? You can look on, on the list of available channels to you. There is a channel called General Forum, right? Where you go to the general forum, and the very first thing I pinned, where you can create or how to create topics. And look, if you ask a question in the chat, it's great for, I don't know, 30 minutes, maybe a couple of hours, maybe until the following day. But then as days go by, that question and the answers will get buried so far. So maybe creating a topic in the forum, right? It'll, number one, it'll stay there for a long time. It'll never get lost. Any follow-up replies will be on that topic, right? So it's a lot easier to find. It's a lot cleaner. So I encourage everyone to use general forum to ask questions pertaining to topics, because same topics keep coming up time over time, and I think that it's just a lot easier to find, and it's a lot cleaner, and I think it's better for everybody for their learning purposes. So guys, there's a chat box here on Zoom. If you don't have any questions, I know a lot of our traders in our community are, far more advanced in the basics of an iron condor. If you just came out to support and to listen to me talk for an hour, great. If you don't have any questions, that's fine too. We'll take a minute or two. If you have questions, I'll answer. If not, we're going to move on about our day. All right. I don't know. Maybe there are no questions. Maybe everyone knows everything, and that's great. If that is the case, that is wonderful. All right. Anyways, if you have questions, don't hesitate. Ask on Discord. I will try to answer all of your questions. Maybe this will encourage others to ask questions. With that being said, guys, thank you for your time. Thank you for coming out, listening to this. And hopefully, I gave you something to think about. Maybe I answered some of the questions you had going into this presentation. I'll be back on Friday. We'll try to do these kind of educational presentations instead of just, looking at the markets and trying to figure out where we're going to go next. If you have topics that you would like to suggest, I am very open for suggestions. Anyways, I got to run. Have yourself a good day. I will catch you in the next one. So long, everybody. Bye bye.